Yes, it's true. You can use rental losses to offset taxes from your W-2 income. And today I'm going to show you how. Hi, I'm Amanda Han. I am a real estate CPA and an investor myself. Now, if you've ever taken a look at your paycheck and realized, how is it possible that I'm paying so much in taxes? Well, you're not alone. But here's what most people don't know. With the right strategies, you can use rental real estate to not just build wealth, but also reduce taxes from your W-2 income. And yes, this is true even if you have a full-time job. And yes, this is true even if you're not using the short-term rental tax loophole. Today, I'm going to break down how to use real estate to offset taxes from your W-2. I'm going to talk about passive loss rules, what it actually means, and how to unlock tax savings through strategies like cost segregation, real estate professional status, short-term rental tax loophole, and how to do it even if you don't meet any of those requirements. Let's dive in. So first, let's talk about why sometimes rental losses cannot offset W-2 income. It has to do with the passive activity loss rules. In the tax world, rental losses are considered passive by nature, which typically means that passive losses generated from rental real estate can only offset taxes from passive income. So what are passive income? Think income from other rental properties, or maybe you may have invested in a business that you're not actively involved in. So let's say I have a friend who owns a museum and I've invested in his business. The income then generated from that business is considered passive income to me. Easiest way to look at it is income that's being generated from an activity that you are not actively involved in the day-to-day operations. So for anyone investing in rental real estate, we can always use passive rental losses to offset taxes from passive income. Of course, with respect to the tax code, there's the rule and there are the ways around the rules. So if you are someone who is a real estate professional, which we'll define in just a moment, then your rental losses could be considered non-passive, which means it then offsets taxes from all different types of income and no longer just passive income. Something else you've probably heard of is the short-term rental tax loophole. We'll cover that in just a moment, but if you can use the short-term rental tax loophole effectively, that also means rental losses that are traditionally passive could become non-passive, thus allowing you to use it to offset all types of income, including W-2. So when your rental losses become non-passive, what are the different types of income that you can use the losses to offset? Well, the possibilities are endless. I know we typically talk about W-2 income because that's the income that almost everybody has, but when your rental losses are non-passive, they can actually offset all different types of income, including capital gains from stock sales, a business or businesses that you own and you're actively involved in, as well as interest, dividends, capital gains, and even crypto income. Now let's talk about what we mean when we say rental losses, because that's a big confusion area. People tend to think that when we talk about rental losses, we're talking about your investment property losing money, but that's actually not the case at all. When we talk about rental losses, we're talking about tax losses strategically created so that you show a loss on your tax return. So ideally what happens is you have a rental property where it's cash flowing and depreciating. Even though the property is cash flowing, you can use tax strategies to offset that income for tax purposes only. One major way to do that is to make sure you maximize your tax deductions. Think home office, business use of car, business meals. These different deductions help you to reduce your taxable income without necessarily impacting the cash flow from the property. Now, after maximizing your write-offs, another major tax benefit to being a real estate investor is that we get to utilize what's called depreciation. So what is depreciation? Well, depreciation is a way for us to write off the purchase price of the building over time. You see, the government understands that there's wear and tear in rental real estate as time progresses. And as a result, we are allowed to take depreciation write-off over the life of the building as we own the rental property. And the most interesting thing about depreciation is that this is a paper write-off we get to take every single year, regardless of whether the property is actually increasing in value or decreasing in value. So a lot of times what you'll see is a property where we have great cash flow, but with maximizing our write-offs and taking the depreciation paper loss, that's how we create a loss for tax purposes. Now, as I said earlier, generally rental real estate is considered passive. So when we create this amazing tax losses, they are passive in nature. The downside is generally you're not able to use it to offset W-2 and other income, although you can use it to offset taxes from different passive income activities. But here's something important to understand. If your income is $100,000 or less, you can actually use up to $25,000 of rental losses against your W-2 and other income. So for people in that income range, you actually don't have to be a real estate professional or use the short-term rental tax loophole. Rental losses can naturally offset W-2 income. Like I said, there is a max, and the maximum amount is $25,000 in any given year. So what happens if you had $30,000 of a loss? Well, you can use $25,000 of that to offset your W-2 income immediately in the current year. The remaining $5,000 carries forward into future years to offset taxes from future passive income. And this is so important because a lot of times people are told by their tax advisor that there is no benefit to investing in rental real estate. But here is an example of how even when you own rental real estate and you create passive losses, they don't expire and they are able to offset taxes from future passive income. Now, if your income is over $100,000 but below $150,000, you could still use a portion of that $25,000 rental loss against W-2 income every single year. It's just at a reduced rate. So the higher income you get, the lesser the tax deduction you're able to use to offset W-2 for that specific year. And now when your income is over $150,000, then you no longer get to use passive losses against W-2 and other income. All of that though do get carried forward into future years, so you don't lose out on the benefit, you're just not seeing the actual benefit today. Now, if your income is over $150,000, again, you can use rental losses to offset taxes from future passive income. And of course, as real estate investors, our goal is always to earn more and more passive income into the future, right? So it's really, really important that you continue to capture and maximize your tax deductions, because even though you may not feel the benefit today, they will definitely carry forward to help you offset taxes in the future. Now, one example might be in the future when you sell your rental property for a large gain. Well, guess what? These passive losses that you're accumulating now do go a long way to helping to offset capital gains taxes eventually when you sell. Now, what if you're someone who's purely passive the entire time you own rental real estate? Well, the good news is in the year when you sell that property, all those accumulated passive losses actually are freed up. And so in that year, you can use all of those losses to offset taxes on the capital gains from the property that's sold. Or even if the gain is lower than the losses that you've accumulated, guess what? You can actually use that loss to offset taxes from your W-2 income in the year of the sale. So this is another great example of how, regardless of what your income is, your rental losses always provide you with a tax benefit down the road, whether offsetting capital gains from the sale of the property or offsetting W-2 taxes in the year of sale, even though you may not have qualified as a real estate professional. Another way to use rental real estate to offset taxes from W-2 income is if you or you're married to a spouse who can qualify as real estate professional. In other words, if you are a real estate professional, regardless of how much income you make, you can use rental losses to offset different types of income, including W-2. So an example might be you are working full-time as a W-2 earner, you have a spouse who is able to qualify as real estate professional. In that scenario, your rental losses can be used to offset taxes from W-2 and other types of income, even if you make over $150,000. So let's talk about what is a real estate professional. To be a real estate professional, it actually has nothing to do with any licenses you hold or designations. So that means you don't have to be a realtor, you don't have to be a broker, you don't have to show houses on the weekends to be a real estate professional. What the IRS looks for is a set of hours and activities requirements. There are 3 requirements and you must meet all 3. The first requirement is you have at least 750 hours in real estate activities. So this could be you being a landlord, you being a realtor, a broker, a property manager, at least 750 hours in real estate. Now, the second requirement is you have to have more hours in real estate than you do at your other job or jobs combined. So for example, if you're working part-time as a teacher and you work about 800 hours a year, then for you, you have to have more than 800 hours to be a real estate professional. Now, for some of you who are working full-time, it's very difficult, if not impossible, to be a real estate professional because you would have to have more than 2,000 hours a year to have more time in real estate than your job. And this is the example of why this strategy is what we call a marriage tax loophole, because it works really, really well if you are married to a spouse who can qualify as real estate professional, provided they don't have a full-time job. Now, the third requirement to meet in order to use rental losses against all types of income is to materially participate in your rental properties. So here you're looking at your hands-on hours and being involved in the day-to-day operations of your rental real estate. There are a couple different ways to qualify for material participation. The most common one is you spending at least 500 hours involved in the day-to-day operations of your rentals. So again, if you or your spouse meet all three of these requirements, then you could be designated as a real estate professional, which then allows you to use rental losses against all types of income, including W-2, crypto, interest, stock gains, and retirement income. Now, I get it, not everyone is fortunate enough to be able to work part-time or do real estate full-time or be married to someone who is able to do this full-time. So this is why we have what's called the short-term rental tax loophole. If you've ever wondered why is it called a loophole, I'm going to tell you why. As I said, when you invest in long-term rentals, you or your spouse needs to be a real estate professional. One of the hardest one of those hurdles to meet is having more time in real estate than your job. Well, when you invest in short-term rentals like Airbnbs, the IRS actually doesn't care how many hours you work at your job. In other words, you do not have to be a real estate professional to use short-term rental tax losses against W-2 and other income. So you could be working at your full-time job and real estate could just be a side hustle. You could potentially be able to use rental losses against W-2 income as long as you meet material participation hours. There are several different ways to meet material participation hours. I'll go over some of the most common ones. The first way is if you and your spouse spend at least 500 hours on your short-term rentals. If you are involved in the day-to-day activities of your short-term rentals and you've earned at least 500 hours, then your short-term rental tax losses could offset all types of income, including W-2 income. Now, if you cannot qualify for the 500 hours, another way to meet material participation is if you spend at least 100 hours on your short-term rentals and no one else has more time than you. So in this example, it could be you having 110 hours and the cleaning crew only has 80, the landscapers only have 20. So you have at least 100 and no one else has more time than you. Then guess what? You can also use the short-term rental tax loss against W-2 and other income. Now, if you're buying short-term rentals later in the year and you just actually are not able to get even 100 hours, the third way to qualify for material participation and use the losses against W-2 income is if you have more hours on your short-term rentals than everybody else combined. So in this example, let's say you had 80 hours. If I add everybody up and their hours are only 40 hours, then you also would have met material participation, which then allows you to use short-term rental tax losses against W-2 and all types of income. The short-term rental tax loophole is really amazing for all types of investors. We have a lot of clients from physicians and attorneys and even other CPAs who are able to continue at their profession full-time using real estate investment as a side hustle and be able to use rental losses against all of that W-2 income. It's important to understand that when we talk about short-term rental, it is not just any property that's listed on Airbnb. The IRS's definition of a short-term rental is a property where the average guest stay is 7 days or less. So if your property is a short-term rental where the average guest stay is 7 days or less, definitely make sure to look into this specific tax strategy. I will say that this is probably one of the most common tax mistakes I see where accountants don't even understand the short-term rental tax loophole. So here's a red flag item. If you invest in short-term rentals and your accountant is talking to you about real estate professional status or asking you how many hours you work at your job or telling you that you make too much income to use this strategy, those are 3 signs that you're working with the wrong tax advisor. So let's go over an example. Whether you are using real estate professional status or the short-term rental tax loophole, if your rental losses are considered non-passive, those losses do offset taxable income dollar for dollar. So let's say, for example, that your spouse is working full-time at a W-2 job, making $300,000 a year. You are the real estate professional. We create $300,000 of rental losses. Well, guess what? The entire $300,000 of rental losses offsets your spouse's $300,000 of W-2 income, in which case now your taxable income in that scenario would be zero. The same exact scenario applies if we're talking about the short-term rental tax loophole. So if you're making $300,000 a year as a physician and you invest in the short-term rental, that creates $300,000 of rental losses. By you meeting material participation hours, that $300,000 loss offsets $300,000 of income for tax purposes. Your taxable income is actually zero in that scenario. So with all that money saved, you can then use it as a down payment on your next property to generate more cash flow and, of course, more tax savings. So to recap, real estate always provides you with tax benefits. It's just a matter of timing. If your income is $100,000 or less, you can actually use up to $25,000 of rental losses against all types of income immediately. If your income is over $150,000, generally your losses are passive losses and they are carried forward indefinitely into the future to offset taxes from future passive activity, or when you sell, it is used to offset all types of income, including W-2. If you're a high income earner, then consider real estate professional strategy to turn passive losses into non-passive losses, or use the short-term rental tax loophole if you and a spouse are still working full-time to unlock those tax savings. If you have any questions, be sure to leave it in the comments below and make sure to like and subscribe, and I'll see you in the next video.